Let me especially welcome our keynote speaker, Bostjan Jazbec, from the board as a board member at the SRB in Brussels, and our discussants, Alberto Nagel, CEO of Mediobanca, and Wolf-Georg Ringe from the University of Hamburg and the academic board of the EBI. After the COVID-19 crisis hit the banking system in 2020, we now see signs that the banks are recovering again when it comes to their profitability. Operating income is increasing due to the improved macroeconomic environment, and the level of provisions is going down. This resulted in generally higher level of profitability of European banks in the first 6 months of 2021. However, the crisis is certainly not over. It is still to be seen what the long-term effects of the pandemic crisis will be on the European economies and how this will affect the level of NPLs in Europe. So far, NPLs have not increased a lot, also thanks to a strong government support measures. However, fast-moving indicators like the level of forborne loans show a sign of deterioration of asset quality in European banks. This will need to be watched very closely. On the positive side, it can be mentioned that European banks, by and large, showed a good level of resilience in this year's EBA stress test. So what are the European banks' risks and vulnerabilities? This is the question we want one of the speakers. The question comes to my mind in this regard is the European banking sector ongoing low level of profitability. We have seen a recovery from the low levels of 2020, as I mentioned before. However, the system is lacking behind the levels of profitability of US banks, more or less since the global financial crisis in 2008. There are several reasons for this, and the reasons may also differ from country to country. But when it comes to ROE numbers, cost-income ratio, price-to-book ratios of European banks are generally behind their US peers. This certainly is a risk to the banking sector. We will discuss this and other topics in this regard, and I'm very happy that we have an excellent panel today to discuss these points. Let me now introduce our speakers in more detail. First of all, Mr. Bostjan Jazbec is a board member at the Single Resolution Board in Brussels and Director of Resolution Planning and Decision. Bostjan became a board member at the SRB in March 2018 and is Director of Resolution Planning and Decisions. In July 2003, he was appointed to the board of the Bank of Slovenia and continued in this post until 2008. After 2008, he worked also as a senior advisor of the International Monetary Fund at the Central Bank of Kosovo and the Central Bank of Suriname. In July 2013, he was appointed governor of the Bank of Slovenia and member of the Governing Council of the ECB. In September 2016, he became a member of the Bank for International Settlements Central Bank Governance Group, and finally he completed his PhD studies in economics at the Institute for Advanced Studies in Vienna and the Faculty of Economics at the University of Ljubljana. Welcome, Bostjan, and thanks for coming here. Second, I would like to introduce Mr. Alberto Nagel. He is CEO and chairman of the executive board of Mediobanca, an Italian investment bank. Alberto works for his whole professional life for Mediobanca, where he served several management positions. He joined the bank in 1991 and worked first in the finance division. From 2003 onwards, he served as general manager of the bank, and since 2008, he is CEO of Mediobanca. Alberto graduated in economics and finance at the Bocconi University in Milan in 1990. Alberto, also great that you're here, and thanks for coming. And finally, Professor Wolf-Georg Ringe from the University of Hamburg and member of the academic board of the EBI. Professor Wolf-Georg Ringe is director of the Institute for Law and Economics at the University of Hamburg and visiting professor at the University of Oxford. His area of research are in the area of capital markets and financial markets. He is research member of the European Corporate Governance Institute in Brussels, academic fellow of the European Banking Institute, and in this function also a member of the academic board of the EBI. Wolf-Georg, also thanks that you're here, and I think I close now my opening remarks. I would hand over to you, Bostjan, for your opening keynote speech. Thanks a lot.
Thank you, Mr. Gstädtner and dear Thomas. Thank you very much, European Banking Institute, for this kind of invitation. That is, of course, with the topics that we're about to discuss today, a very interesting and timely topic. Why? Because it is exactly the point on this trajectory of where the European banks might turn the part of the solution or part of the problem, as we've encountered in so many periods in our history. As you might remember, a year and a half ago, when we were pretty much all going into confinement due to the COVID crisis, it was kind of loudly pronounced that this time the financial crisis might somehow bypass us, because the banks should and are part of the solution. But now, after a year and a half, we are still there trying to discern on the real extent of the COVID impact on our economies, and the things might not look so rosy as we've so far tried to explain to ourselves and of course to general public. I would always try to replicate what Churchill famously said a long time ago: never waste a good crisis. And this is also something that might be a part of today's discussion, particularly because the economic recovery that we are all expecting now should indeed also be intermediated through the good stance of the banks. So if I can ask for a share of the slides, we might follow, and then I guess that the slides were distributed to all of you. The pandemic indeed triggered the very unprecedented global economic downturn. If we go to the first slide of my presentation, and indeed affected all spheres of our lives, from very personal, private ones. I mean, this is only my second week at the office after a long time of not coming to the office at all, and then doing all my job requests from online, and then trying to prove that even as a crisis institution, as a single resolution board, we can do everything online, and it is of course a good indication that the work has been done, but that still the sheer fact of the evidence of being in the office is of course something that maybe indicates the slow recovery and then return to new normal, and that this new normal also addresses the questions in the banking sector. The banking sector, of course, is greatly impacted by all the public measures that have been introduced from the very beginning, and this is something that might indeed masks the real stance of the banks today. So the question whether banks will be part of solution or part of the problem is still the one that I don't dare to fully address and even try to answer. But I'll give some reasons of why we might be a bit more cautious there. So if I might ask for the next slide. So Thomas already mentioned some of the vulnerabilities of the banking system in Europe, in banking union. Low profitability, NPLs, cost efficiency. These are the usual suspects when discussing the banking system in Europe. As you will see, I will try to avoid using the adjective European banking system in this respect, because to me, you know, after being a scholar of the European banking system, the more I learn about the European banking system, the more I say that we have a compendium of the national banking systems rather than the European banking system itself, because after about 20, since 20 years of having the single currency, 7 years of having the single supervisory mechanism, 6 years of having the resolution mechanism, the extent of the cross-border banking activities in Europe is even lower than it was 20 years ago. So the extent of the cross-border credits and cross-border deposits is in the levels of less than 5% of the total balance sheets of the European banks, which means that obviously we need to be very honest in defining the European banking system in probably different terms. We do have a national banking system, and those national banking system try to act as a European banking system, but for me that is still a bit of a difficult to admit that we indeed have to deal with different regimes in this respect, and this is also seen in terms of the study on economic environment and then different responses that national governments had to this banking system. Why? Because as much as there was the European approach in terms of the recovery measures from Europe, the national measures were just more effective, and these measures are the ones that seriously affect also the balance sheets of the banks in this respect. So to come back to the national banking systems in this respect, all scholars of banks and then financial markets would probably start every single discussion on the banks as first claiming that banking is all about the economies of scale. Economies of scale are very unused in the European banking system, because we today have more than 3,000 operating banks in the banking union alone, close to 5,000 in European Union in this respect. And for me, the sheer number of banks there shows that a lot of work needs to be done to further support the integration and consolidation, which should not only take place within the national borders, but also in cross-border aspects. So for this reason, if I can ask for next slide, for me, the crisis or the current stance of the European banks or national banks in European context, it should indeed be to do the self-reflection into where, in terms of competitiveness, banks really stands. What do we really understand by the banking union? Is it really the universalism versus the territorial approach in this respect? How exactly do we understand the financial integration in Europe? And what are the hampered and hindrances in this respect that are considered to be the regulatory burden that the banks are today facing in this respect? For me, the question of low interest rates being the only factor for low productivity is not the low profitability of the banks is not the right approach. If we look at the banks in Europe in terms of their cost of income structure, you would see that European banks or national banks in the European countries are cost ineffective. Mostly, on average, the cost of income ratio in banking union are around 70 to 80%, while compared to banking business in the Nordic countries or even in the US, where the cost of income ratios are much lower, shows the potential pitfalls and drawbacks in terms of financial and then banking competition in this respect. Interest rates are indeed a part of the story, but I'm happy to discuss this further. For me, the question of taking advantage of the economies of scales, supporting the cross-border consolidations is the way forward. But there, I think that we should not talk about the economics anymore, but more of the political aspects of where those issues and the question should be raised. I know that I'm taking a little bit of a black and white and a very radical approach there, but I guess that a certain level of radicalism is good for discussion in this respect. I do believe that we should ask ourselves where do we stand in Europe, and then maybe try to get out of this introvert approach. Why? Because comparing Europe to other jurisdictions, we see that now after Brexit taking place, we lost the only European bank among the top 10 world banks in this respect, namely HSBC was before considered to be the European bank. Now it's a UK bank, so we don't have any European bank among the top 10 world biggest banks anymore. So we should start asking ourselves how to make the European banking environment again supporting the competitiveness and maybe environment that would support the establishment of a big European championship. While going around the countries in Europe, we are usually talking about the national champions, banking champions supporting the national real sector champions, and it's very few occasions that you would hear the term and adjective. Let's talk about European banks there, and then how the European banks can contribute to the great European Union real economy. In this respect, I would skip the last slide, which is the way forward in terms of the resolution. Why? Because I hope that we are far away from resolution at this point. Though I can only assure you that at least from the single resolution board point of view, we are doing everything to make the resolution happen. But again, we are faced with all the challenges that originate from very national concepts of resolution. Also in this respect, we do have the European resolution framework, but we still have a very scattered national insolvency regimes, which flavor the nature of resolution if it ever happened. And just to conclude at the end, to the very end, if we had guts of setting up the CRR, which is the regulation, obviously there was not enough guts to set up also the regulation on resolution, and it was only directive. And those of you who are scholars of the European frameworks know what is the difference between regulative and directive approach in this respect. And I would just stop there and say that I am optimist in terms of setting up the European framework, but we are far from having the complete story there, and a lot of efforts should be put there. And maybe any crisis, even the COVID crisis, should teach us the lesson and make those efforts even stronger in direction of indeed having the justified use of adjective European when talking about the banking systems at large. Thank you.
Bostjan, thanks very much for your presentation. If I might add just a small anecdote based on a conversation I had recently with people from big investors, and they basically were also saying when it comes to investing in banks in Europe, they don't have a European approach. They invest into a bank in France, in Germany, in Italy, but they don't invest into European banks because there is not a really European banking market. That's how the investor side is seeing this at the moment. Yeah. Thanks very much for your presentation. We would now move to the private sector participation in this regard. So Alberto, I introduced you already, CEO of Mediobanca, a big Italian investment bank. I hand over to you, Alberto. Thanks.
I found the presentation of Mr. Jazbec very interesting, and I may touch some of his point of his presentation during my presentation or in the the Q&A session. I prepared a small presentation which covers, on one end, starting from a sort of a capital market view of the European banking sector. This is because of our daily activity. We do a lot with M&A. We do a lot of M&A for banking in Europe, and we are quite active as equity brokers. So we have developed quite an interesting and deep view of the sector, in particular in Europe. So we can say that on the positive side, stronger than expected economic recovery with upwards revision of GDP growth estimates, strong support measures preventing risk of a systemic risk, no significant signs of asset quality deterioration visible as yet, even after the expiry of moratoria, because most of the moratoria are over. Effective vaccination programs are supporting the reopening of the economy on one end. Yet we see risks. NPL cycle is yet to emerge and is likely to affect specific sectors: hospitality, tourism, entertainment, transport, leisure. Supply chain disruption and surging energy price could trigger inflation, hamper the recovering consumer spending and disposable income, and jam the macro recovery path. The jury is still out on the efficacy of the COVID vaccine to fully reopen economy without restriction future lockdowns. So, in a nutshell, economic recovery is underway and better than expected, but not without risks. If we see this in the context of how is the impact on the P&L and the trajectory of the profitability of European banks, of course we need to take into consideration the ECB monetary policy. We know that the Eurozone monetary policy has stayed dovish for the past years, reflected in ever-dropping front book yields. So basically the NII of banks in the last few years was already under pressure, and what we see now, short-term energy price and reopening of the economy and disruption to the supply chain are resulting into the short-term increase in inflation. But this is not something that will support NII, because we see in the left part of the slide, now there is a front book which is much lower than the back book, and so NII will continue to be under pressure. This is also visible in the confrontation with the US yield curve, where we have better economic trend, higher rates, so the possibility for US banks to generate real NII is much better and much stronger than that one for European banks. Notwithstanding this, so notwithstanding the fact that the main, if I may say, the main pillar of the P&L of European banks is under pressure and will stay under pressure, we see three value drivers to support the sector. Better than expected cost of risk. So the consensus of the market is embedding a worse than expected cost of risk. So we see that there will be a better contribution to the P&L deriving from better than expected cost of risk. Supportive income because of the trend of wealth management in general. The fact that the markets are positive and continue to be positive is a strong catalyst for fees, as well all the activity in corporate investment banking. And there is another important catalyst, which is capital return. capital return, because thanks to the supervision action, banks are holding much more capital than before, and today, theoretically, the possibility to distribute 30% of market in terms of free capital. Of course, this is a theoretical calculation, but this gives the idea of the possibility for banks to distribute, and to the investor also the appeal of the sector again. So there is what we can is a value case for European banks to be in the portfolio of asset managers and institutional investors more than a year. So the case is stronger, standing the risk. There are, as I said, some important opportunity. Now, coming from a capital market view of the sector and going to a more specific approach of our institution, how we dealt with a number of issues during the crisis and how we cope with the impact of monetary and fiscal policy. Of course, as we said, as Mr. Jazbec anticipated, the action of ECB in particular is in terms of liquidity, in terms of rules, the life of banks, and put a lot of liquidity into the system. This helps banks, help the economy, but then there is the concrete risk that this is also altering the correct market pricing of credit risk. In other words, the risk associated to lending in general in the system is now not fully priced, and this mispricing may also lead to excessive risk-taking. So we think that, and it is what we have done, notwithstanding we have used all the possibility to transfer the policy stimulus to the economy, we have been reviewing our screening process in lending on a selection of risk opportunities at origination is, I think, the most important defense into protecting not only the P&L, but the balance sheet of the bank. Then comes what can banks do, what can they do to cope with the NII pressure. In general, and we will touch this later on, there is the necessity of reducing the dependence from NII. Banks should be more sophisticated institution where the so-called low-hanging fruit of the certain activity over the next few years will be less important, and will have to evolve into more client-centric institution where more value-added service and product can be provided to the client. This is thanks to our size, to our DNA, to our. This is we have been last 20 years. So we have evolved our business model from an institution which was considered an old company, more bank, into a specialized, diversified financial group, where we go vertical in some business which normally tends to give better expectation, return on tangible equity, and better margin in general. So basically, our activity has been to develop business that are typically benefiting from low interest rates, and others are benefiting from the opposite business cycle. The bank has evolved towards a different NII mix in creation of management. So being bigger in wealth management, it's another way to cope with actual difficulties posed by the pandemic, as well as in general, as I said, providing customers with more sophisticated or value-added advice or product. This is so seen in P&L evolution in general of some other European banks, where not only wealth management became more important, but also private banking and the activity related to capital market and acquisition finance became more important. Now, going forward, the exit from support management, new investment cycle. I'm topic be Mr. Jazbec spoke about NP possible generation as one of the issues, which of course is going to be the elephant in the room. We are quite sure that the NP generation will be bigger in the couple of years. It's fair to say banks, thanks to ECB, they are much more prepared to cope, withstand a possible new NP generation because capital level, because also internal. Now, we have seen in our experience that we are the bank, at least in Italy, with a low NP ratio. And this has been, of course, the results of the criteria selection criteria in credit that I was mentioning, which was always very robust and has been even more robust during the COVID. So dealing with NP, if going to segment, I think we can't consider all NP as equal. So we need to separate the different kind. In our experience, we have proved that there are some generation NP which need to be treated in a way that you sell them straight away. We did it and we continue to do it consumer, where we sell all the NP warehouse every year. But there's been, in our experience, other kind of NP where you get more value, not only for yourself, but for the economy, if you deal with them over a longer period of time and you treat them. So most of our level 3 likely to pay assets has been treated in the last couple of years, 3 years, and most of them went back to stage 1 from stage 3 because of active dealing, active restructuring with the counterparty. And this resulted into, I would say, quite a positive results, not only for the P&L of the bank, but for the fact that most of these counterparties not only are alive, but are restarting very positively. So I think the approach should be careful and should be such that will protect the European banking system from future crisis, but we have to go and deal on different category NPs and help the bank not to lose value with a misstatement of category. In general, the new investment cycle will generate NP via asset buy, but also because a lot of the economy system will have to evolve towards more sustainable business model. If we think about sustainable business model, energy transition, it will be important to allow banks to follow up on developing economic structure and enable corporates to finance this kind of transformation. I think we need sort of flexibility. So thank you very much. I now available for the follow-up.
Thank you very much, Alberto. The line was sometimes a little bit bad, to be honest, but we come on these topics later on in our discussion again. Thanks very much, first of all. And then I would hand over to Georg Ringe. Over to you, Georg.
Thank you, Thomas. It's great to be here. Thanks so much for including me. And I don't have any slides, so you'll have to bear with me in person. But I'd like to build on some of the points that my pre-speakers have been given. So you've been given a wonderful broad picture perspective. And what I'd like to do in my 5 minutes is to draw your attention to one current policy debate, namely the implementation of Basel IV capital rules in European law, and illustrate how the COVID pandemic influences such a project, or how it might also be used, the COVID pandemic, as an excuse to influence particular changes in the legislation. I know many of you will be familiar with this. Just very briefly to get everybody on the same page. So Basel IV, or still Basel III, as some call it, is the final package, basically, of post-crisis regulatory reform to further strengthen the capital requirements for banks was agreed by the Basel Committee in 2017. And one of the key elements, which most of the current discussion is floating around, is the so-called output floor. So the output floor means essentially that when banks use their internal models for calculating risk weighting, that internal calculation method cannot drop beyond 72.5% of a standardized model. So it's basically, to make it simple, it's making it less easy to use internal models for calculating capital requirements, and thereby strengthening the capital, tightening up the capital requirement. So this was proposed, as I said, in 2017, and was supposed to be phased in by 2022. So starting in a couple of months, it was already delayed to 2023 by the Basel Committee because of COVID, right? Because it was argued, as we've heard before, that we need the banks to free up as much capital as they can to lend out to the real economy. So the Basel Committee postponed it to 2023 to be phased in, obviously, over a couple of years. And the full 72.5% will only be effective in 2028, right? So it's really coming at a long distance. But there is heated debate now at the moment in Brussels because the European Commission is about to make its proposal on how to implement this. And we expect that in October. Now, as you can expect, that sort of thing is heating up the political discussion and causing a lot of confrontation because some European member states are less willing to comply with the text of that agreement than others. And the reason is that particular German banks and Scandinavian banks, also French banks, use a lot these internal models and probably have to face higher capital costs and also disadvantages in comparison to US banks. So this is why, the banks have been campaigning for a long time now for a sort of, to put it very bluntly, a sort of a modified version of the implementation, a watered down framework to implement this with some specific add-ons, specific modifications into European law. And the primary reason that they give, well, they give this competition with US banks, but it's interesting that they've recently framed this as a post-COVID problem, or not post-COVID, but within COVID problem, right? Because the argument goes, we need banks to keep on lending to the real economy to get over the problems of the pandemic, and therefore it will be toxic, they argue, if now capital requirements for banks are being tightened. And the other argument that is also coming very handy is the European Green Deal and sustainability in the market, which I was surprised to not hear before as a topic today, because that is so very much in the air. And always goes as a nice argument as well, right? That it would be toxic. We need the banks now to finance the Green Deal and the transition to a more sustainable economy. So this is the argument, and this is the nexus here of this current debate around very technical capital requirements as it's been implemented during pandemic crisis, right? And of course, there is a big movement in the other direction. There are many central banks and regulators just published a couple of weeks ago a public statement saying we need to implement Basel IV 1-to-1, so no deviation, please. But behind the scenes, some were missing, some signatures were missing on that statement. Some countries are openly taking a sympathy for the position to water down the and notably the governments in France, Germany, and Denmark, I think. Also Luxembourg is somewhat on this side and trying to find other solutions of implementing it. So and just thought this is a nice case study of showing how regulation that was agreed in the face of a big the aftermath of a big financial crisis is now, when it comes to implementing it, because several years have passed since then, right, is suddenly now seen as a big problem. And the trouble is that the Basel standards, of course, are not technically legally binding on any implementation. It's just usually a version of which is implemented in European law. And so this is what the debate is all about at the moment. So let me conclude by offering some thoughts on how this might be solved. I do not think that we will see another further delay of that implementation process, because COVID is on the decline, is receding, and there is no appetite for further delaying the whole thing. As always, expect a certain compromise on the European level, a dilution in the way it has been implemented, probably even with local differences, maybe some exemptions being brokered on the European level at the moment. And it's not the first time that European law, or American law actually for that matter, has implemented Basel requirements in a very creative way, let's put it that way. So I hope that a case study is of interest in the current context and shows us the dilemma between, we need banks to keep lending to the real economy to get over the crisis, but on the other hand, of course, we need strong banks that are well capitalized in order to weather the next crisis. And this is the dilemma that we are currently in. Thanks so much, and I hand over back to Thomas.
Thank you very much, Georg, for this presentation and for this speech. We are already in the middle of the regulatory debate in this regard, and we have now around about 20 minutes for a Q&A. To the audience, we also have a Q&A tool, so if you have any particular questions, just write them into the tool, and if they fit to the current discussion we are having, I will obviously read them aloud. But let me first of all start with a question, I would say, to all three of them, from the public authority, from the private sector, and from academia. First of all, looking back a little bit to the regulatory measures and supervisory measures taken in connection with the COVID crisis, to help the banks sustain in this crisis. First of all, what do you think about, let's say, the success rate of these measures taken by the regulators, the Commission, nationally, but also by the supervisors, by the ECB, for example? And a little bit looking forward, what measures would you think would further assist banks to alleviate, let's say, the stress in the economy, and how any additional measures could help the banks to alleviate the recovery in the economy? So I would be split it into two halves. So a little bit looking back. So how do you assess what has been happened so far, and is there anything which could do in order to further help the banks to mitigate the stress in the economy? Maybe Mr. Jazbec, I'll start with you.
Thank you for this very interesting question, which can be answered by a current dilemma that we are faced to today. Namely, we're all afraid that if the measures are withdrawn, that we would have and we will experience the cliff effect. So obviously the measures work to the point that that help weather the waters, but then on the other hand, nobody dares to make those measures disappear overnight, because we don't know what is the real situation, particularly in and I'm looking very narrow-mindedly now in the banking industry. I think that Mr. Nagel indicated certain areas from the banking perspective, but from the regulatory perspective, indeed, it is to me very unclear the way certain developments have been unfolded, namely some banks that were rather troublesome even before the COVID crisis, now all of a sudden reduced the levels of NPL. So they're obviously something that has taken place, something that the regulatory supervisory measures indeed help to maneuver through, and then it is just a question how truthful those financial indicators really are. And that is something that none of us can know today, and it is for sure the concerns that we have not only at the monetary policy side, namely the current discussion on should we continue with should the ECB continue with the support measures, what is the real extent of some Scandinavian central banks already increasing the interest rates? What is the interplay between what is the European Central Bank doing in contrast to what the US is planning to do? All those measures, of course, flavor and then somehow indicate the issue that European banks might face in this respect. And then, of course, the question that is very, very important and pertinent, namely something that Professor Ringe mentioned. This is the question of capital adequacy. If some of us spotted yesterday in Financial Times the article saying, look, the supervisory measure of retaining the profits in the bank helped close the gap toward the Basel capital standards, is of course also an indication that some might perceive the current affairs in the banking system a bit through the rosy glasses, namely, if there are no NPLs, if banks are increasing their capital stances, so we should not worry at all. But I'm not sure whether this is the true reflection of everything that we have endured during the COVID. And as I said before, I don't dare at this point to give any answers. I'm just taking the privilege of raising additional questions and concerns there, and I hopefully somebody will help me answer them. Thank you.
Thank you, Bostjan, for this answer. Then I would hand over to you, Alberto.
Yes, I that today now you can hear me better, because before the voice was not clear. But coming to your question, I think that ECB in general, the other entity in Europe, worked very well during the crisis, because the scope of their intervention in terms of liquidity, capital rules, Victoria treatment were huge, prompt, and clearly made a difference in dealing with this. Without this kind of measure, the crisis would be being totally different. Now, to the future, what we want to see, as we all know, the SSM is a young entity because it was started a few years ago. And looking at the future, we at Alberto, we think that over time, the activity of supervision is centered not only on normative set of framework, but also is more market-friendly, pragmatic, and principle-based. And this is coming because it's taking time, but I mean, it's something that is the normal evolution. In general, what we see is very important, like everybody, to make the life of European banks easier, is having a real banking union and fill the gap with the situation that some competitors of the European banks, notably the US banks, can enjoy. Because if we compare many fees, what US banks do on their own country and the rules that they have compare to what we have today in Europe, there is still a gap to be filled.
Thank you very much, Alberto. Georg?
Yeah, I think I broadly agree with Alberto. I think the crisis response has been sound, has been active, and maybe something we should ask you, Thomas, but I think, the ECB has been really pragmatic in encouraging and nudging and pushing banks into, using all those buffers that were available and encouraging banks to lend. And this is what those buffers are for, after all, right? So the system did work, and that was really good news. At the same time, I think, I'd like to make a connection here to my earlier point about this eternal problem of competition on the global stage. So if Europe and European banks were alone in the world, then we would probably be much more assertive. However, since we are faced with competition from Asia and from North America, it's always in the back of people's minds, of policymakers, look, we need to ensure that European banks are competitive on the global stage, and we need to ensure that they are not at a disadvantage in comparison to others. And this is the problem that inevitably influences policymakers during those times.
Thank you. Another topic I would like to address is the area, you spoke just about competitiveness of European banks, and one area that we have been speaking about is the profitability of European banks. And maybe I start this time with Alberto about a question about what European banks generally should do in order to deal with this. The expectation is that the low interest rate environment will be there for some more time. Yeah, so analysts also not expecting a big change, at least not in the short term. Many banks are strongly exposed to net interest income. You shared with us what you're doing for Mediobanca in this regard, but what is your general, let's say, thought if you look at the banking system on a wider scale, what could be done in order to deal with these consequences? And one question I would like to add, actually, because it's also something I thought about, which is also coming from the Q&A tool, is cross-border mergers. Obviously, it's also something which is always discussed in connection with profitability of the banking system in Europe, whether Europe is overbanked or whether there should be more mergers, bigger banks, in order to have a bigger scale in this regard. Is this something that you see coming in the short term, or is this something which is not coming because of regulatory or legal hindrances? There was one point which is raised in this regard. Alberto, maybe I'll start with you now.
Thank you, Thomas. I think in general, the European banking sector is a bit over-reliant on NII dependency. And this is not going to be helped. Why? Because on top of that, in Europe, you have a capital market for the debt issuance, which is much less efficient than US. So what will happen is that in Europe, you will have more and more substitution of loans to corporate into corporate bonds. So you have then, of course, the retail side, which is going well. So you can offset part of this, but between a new margin, which is decreasing, and the new volume, in particular corporate, net of acquisition finance are declining, you see that you go against the wind. So what you should do is basically increase with some appetite, limit volume, and you can do it partly, but in particular you have to substitute this kind of revenue with a different business model. No? So then it comes how banks should evolve in the future, maybe a future question, but there is a lot of transformation, digitization, which is needed in order to shrink costs, to substitute revenue, and to have a better profitability at the rotor, because otherwise you don't get to a different end game. So NII is part of a much more complex and wide transformation of banks, which is needed, and I think the COVID may have this, the post-COVID. Coming to M&A, honestly, I don't see a catalyst today, as of today, speaking with some, if most of the in Europe, I don't see a strong catalyst that is pushing to do cross-border. I see a strong catalyst in terms of what we can say to shareholders in terms of pick up in EPS, synergy, restructuring cost. So there is not a strong case up there, so we need to work ecosystem which creates element for an equity story to be big and investor side. Still, there are a lot of consolidation in intramarket. May happen some consolidation driven more by, I would say, a business. So you may see some consolidation in wealth management, you may see consolidation in insurance, consumer. But when it comes to, big, important merger and synergies required between two network universal banks, which are operating around Europe, then this is much less convincing.
Thanks very much. That was a very clear answer on this. I guess not what one always wants to hear, but I mean, understandable. I mean, there must be also a reason that, let's say, 20, 15 years ago, we had by far more cross-border activity than now. Now, from a regulatory and a supervisory side, we're by far more advanced. So there must be other reasons as well why this is not picking up at the moment. But I would now extend the question also to Mr. Jazbec.
Thank you. I guess that Mr. Nagel really hit the point with his explanation. So there's very little to add, and then plus, I mean, it's from the regulatory point of view, it's very difficult to say how the bank should do their job. It's for us to see that we do keep the regulatory framework in some common sense limits, and this is not always so. I mean, I admit we ask for more every single year, and this is not necessarily the best way forward, and that's why I would always come back to where I started my presentation today, namely that we would indeed need to have a higher harmonization and synchronization of different approaches in different parts of the jurisdictions of banking union. But it is true that cost structure of doing banking in Europe is indeed at this moment unsupportive in a sense of presenting probably the most crucial determinant of the low profitability. I mean, it is when you look at the cost-to-income ratios over 80% in certain banks, it is very difficult to conclude that those banks might have any room to increase the profitability. And then on the other hand, with increased competition that is not only coming from within the banking system itself, but particularly in terms of the fintech payment industry. In this respect, I would assume that the only natural next step is that banks starts reconsidering their business models and try to squeeze the cost structure in a way that would support their long-standing existence. Then the thing on cross-border, don't get me wrong. I'm not there to support the cross-border just for the sake of doing something cross-border in the banking. I truly believe that the good local regional banks that know their customers are indeed needed, and it is something that would never be expected from a pan-European or a very global institution in this respect. But it is also true that some economies of scales needs to be reconsidered, but for that, I guess we would need another couple of hours just to get to the point of seeing all the obstacles that are currently there in terms of European banks. Coming back to Basel, for example, Basel standards do not recognize the banking union as a single entity. You still have to have the cross-border capital buffers in this respect. So if we want to start somewhere, let's start from the very top, and let's start considering and taking into account and defining the banking union or the euro area as a single entity, and then we would immediately start gaining some costs. for me, the point that I just made, that the banks doing cross-border needs to have additional capital buffers while we are where they are dealing with within the same administrative and then legally recognized entities is for me just mildly say surprising. Thank you.
Thanks a lot for this. Because it's 4 o'clock already, I would like to have a short question and ask for short answers from all 3 panelists, please, when it comes to, let's say, the impact this pandemic crisis could have on the banking system in Europe long term. What risks and challenges do you think are going to arise as a consequence of this? And looking at the time, I would ask you for very short answers, each of you, please. Maybe Bostjan, you start.
I just hope that we will not waste this crisis or to make the improvements. How these improvements will be seen. I mean, it is for sure that the limited mobility of all of us while being in confinement did change also the nature of the banking. So that is something that will perhaps be most visible in terms of our approach to the banks, and then banks themselves will probably find the ways to further strengthen their balance sheets, and then maybe from the last financial crisis learn how to deal with unfavorable developments of potential new NPLs. Thank you.
Thanks very much, Georg.
Yeah, I'm generally optimistic. You know the saying, never waste a good crisis. So I think there is something useful in every crisis, in that we are again reminded how important the banking sector is for keeping the real economy alive. And I think Bostjan started with asking, is it part of the problem, part of the solution? I think there is consensus now that so far it has been more of a solution, which is really good news. And so I see the crisis for the banking sector at the moment as something more of an opportunity. I have highlighted, however, that there is a temptation always in policymakers to go the other way around. And politics is always, if there was no politics, it was just economists making those rules, then it would be a different world. So that's like a little poison creeping in here. And one solution maybe could be to make the Basel standards more binding, for example, so that they cannot be watered down. But that is sort of mission impossible for the next big crisis, I think, to come.
Georg, thanks so much. Alberto, you got the last word.
The impact we see in on the banking sector is the push on digital, because honestly, we never imagined that our banks could be, be operating remotely without glitches for months. I would have never imagined. And it worked. So it created a different, attention and prioritization of the digitization of the system, which is now really going faster. So it will be very important to go on with this process of reshaping the business model, have a push on digital, and ultimately, like any crisis, will create a bigger divide between banks that, because of market position, either because they are big, well-run universal bank or a specialized group, are returning a good kind of return to investor, as opposed to others which are smaller or are having, a reassessment of their digital push, which is way behind, which will lag behind the others. So there will be a divide, a bigger divide at the end of this pandemic between these two kind of categories.
Thank you very much, Alberto, and thanks to all of you for participating. Bostjan, thanks very much for joining us here. Alberto, also thanks and greetings to Milan, and Georg also to Hamburg. And I hope all of you enjoyed this discussion. You will be able to see it on the EBI website, where it was recorded and then put on the website. We will see each other again in October for the next policy series. So thanks very much and have a good afternoon. Bye-bye.